Okay, time to learn a new word, account. What is an account? An account is a place where we record all the effects of transactions that relate to a certain item. For example, we're going to have a cash account. We'll keep track of everything that happens to cash in one place. We'll have an accounts payable account. We have an account or a tab with our suppliers. Everything that impacts that, so when we buy on credit, when we pay off some of our bills, we keep track of that in one place. We've got an employee wage expense account. We're going to organize and say, okay, everything that happens with respect to our employee wages, let's write that in one place, and we'll call that an account. Now, an account really used to literally be a page in a book where we keep track of everything with respect to one item, cash, accounts payable, inventory, those kind of things. These days, an account is usually a designated location in a computer file, but it's useful to think of it as in the same way. It's a good mental image to have. An account is a page in a book where we keep track of all the things related to a specific item. So we have an account or a page for cash. We have an account or a page for inventory, and an account or a page where we keep track of everything with respect to our buildings. That's an account. It's a page. It's a place where we keep track of all the information related to a certain item. Okay, so let's use accounts in the accounting equation. They kind of fit together here. So we start the business, the same thing that we talked about a bit before. We're going to start a business by investing $50,000 cash. Well, let's not just call this an asset, some generic asset. Cash goes up. We're going to keep track of that cash account, the specific item in detail here. And it's not just a general equity, it's the capital stock or contributed capital portion of equity. So we're keeping track of specific accounts. More detail, we're drilling down a little bit, keeping track of things at the account level. Now we're going to borrow $25,000 cash from a bank. All right, our cash went up again by $25,000. Where did it come from? Well, the source is notes payable, a particular kind of liability. Notice that we're getting a little bit more detail here. The accounts, the detailed things, the cash, the notes payable, the capital stock. Still, though, we notice that our balance sheet balances. Total assets, $75,000. Total sources of financing to buy those assets, $75,000. Add it up, ladies and gentlemen. Let's do another transaction. Buy inventory on credit for $14,000. Okay, two accounts are impacted here. Our inventory goes up. Now, where do we get the money to buy that inventory? We didn't pay for it in cash. We promised to pay later. So our accounts payable, that account, goes up. So we're keeping track of the detail here. The inventory account went up and the accounts payable account went up. And we still see total assets, in this case $89,000. Total liabilities and equity, still $89,000. Our balance sheet still balances. Let's buy some equipment, $15,000 cash. So the equipment account goes up and our cash account goes down $15,000. So yeah, in total assets don't change, but our mix of assets, we got less cash, we got more equipment. We're keeping track of the details now, the accounts, the individual pages, the detail about cash and inventory and equipment and accounts payable, notes payable, and capital stock. We still see, though, even though we're keeping track of the detail, total assets, add that up. When I add that up, I get $89,000. Where do we get the money to buy the $89,000 in assets? Well, I add up liabilities and equities, 14 plus 25 plus 50. Yeah, it's $89,000. The balance sheet still balances. Accounts keep track of the details with respect to specific items, but still, we can handle that. The accounting equation still balances.